Imagine a world where moving your money, anywhere on the planet, is as effortless and instantaneous as firing off a text message to a friend. No waiting, no excessive fees, no bureaucratic hurdles. Just pure, frictionless value transfer. This is not just a utopian vision born in the minds of technologists. It is the bold mission that Ripple, one of the globe's pioneering blockchain companies, has been pursuing for well over a decade. But today, this very dream faces an unexpected adversary. Not a technical limitation, but the very legal frameworks and institutions meant to protect us all. As strange as it sounds, the fate of digital assets in the United States, home to Silicon Valley and the world's most influential capital markets, hangs in the balance, shaped by a battle playing out in the halls of Washington. Why is Ripple's ongoing clash with American regulators making global headlines? And, more importantly, what does it truly mean for the tens of millions of Americans, and indeed hundreds of millions worldwide, who are staking their futures on the promise of crypto and blockchain technology? To understand the stakes, let's rewind and break down Ripple's story and its ambitious visions. Founded more than 10 years ago, Ripple was launched to tackle one of the world's most persistent financial bottlenecks: the slow, expensive, and opaque process of moving money across borders. Brad Garlinghouse, Ripple's charismatic CEO, has long championed the idea of an Internet of Value, a world where money can move as freely and efficiently as information does on the Internet today. At the core of Ripple's platform sits the XRP ledger, an open-source, decentralized blockchain. Unlike the energy-hungry blockchains of the early crypto era, the XRP ledger was engineered for efficiency, capable of processing thousands of transactions per second with minimal energy consumption. Its native digital asset, XRP, is not just a speculative token. It is the fuel that powers instantaneous settlement for cross-border payments, digital asset custody, and even more advanced use cases like programmable payments and decentralized finance. Just imagine, you work in New York, your family lives in Manila, and you need to send money home. Traditionally, this process could take up to a week, with multiple intermediaries siphoning off fees at each step. With Ripple's technology, that transfer can now happen in mere seconds, at a cost so low it barely registers. In fact, over 60 countries have recognized the potential, granting Ripple the regulatory green light to operate and innovate within their borders. Central banks in Asia, Europe, and even Latin America are now experimenting with Ripple's infrastructure for their own digital currencies and payment rails. Yet, ironically, the birthplace of global innovation, the United States, remains one of the most challenging environments for Ripple. The reason? Regulatory ambiguity. In the absence of clear and modern rules, the American crypto landscape has become a minefield, stifling not only Ripple but countless other innovators. This uncertainty came to a head in the year 2020, when the United States Securities and Exchange Commission, or SEC, launched a highly publicized enforcement action against Ripple. The SEC alleged that Ripple's sale of XRP constituted an unregistered securities offering, a charge that cast a long shadow not just on Ripple, but on the entire American crypto industry. The legal battle that followed was nothing short of epic, stretching over several years, costing untold sums in legal fees, and forcing Ripple to defend not only its own interests, but the very right of digital assets to exist in the United States. The result? In a stunning turn, the courts ruled that XRP, in and of itself, is not a security. Brad Garlinghouse hailed this as a watershed moment, a victory not just for Ripple, but for all American crypto holders. He declared, "We prevailed," and across the industry there was a sense of vindication. But the celebration was short-lived. The ruling, while significant, failed to provide the comprehensive clarity that companies and consumers desperately need. Instead, it underscored just how fractured and outdated the American regulatory approach has become. Here's where things get even more urgent. Over 60 countries have already granted Ripple licenses, and many are actively courting crypto innovators. But in the United States, the lack of clear rules leaves companies guessing. Will the next innovation be welcomed, or will it trigger another enforcement action? No one knows. This regulatory fog is not just a headache for entrepreneurs. It affects everyone, from institutional investors managing pension funds to everyday Americans experimenting with digital wallets. Brad Garlinghouse, never one to shy away from a fight, has taken his case directly to Capitol Hill. He is now testifying before the United States Senate Committee on Banking, Housing, and Urban Affairs, urging lawmakers to finally bring order to the chaos. His message is simple yet powerful. The United States risks squandering its leadership in one of the most transformative sectors of the global economy. Over 55 million Americans already participate in the crypto economy, supporting a market now valued at more than $3.4 trillion worldwide. If Congress does not act, he warns, innovation will simply migrate to friendlier shores. Garlinghouse is not alone in his call. Across the industry, a growing chorus of voices is demanding action. Sheila Warren, CEO of the Crypto Council for Innovation, underscores it. Regulatory clarity is essential for fostering innovation. Jake Chervinsky, a leading blockchain advocate, warns, Congress needs to act swiftly to create a legal framework. And Kristen Smith, executive director of Coin Center, reminds us, a balanced approach is needed to protect consumers. But not everyone is convinced. Some policymakers fear that loosening regulations could expose consumers to new, unforeseen risks. They point to past financial crises sparked by unregulated speculation, from the dot-com bubble of the late 1990s to the mortgage meltdown of 2008. Others counter that the current patchwork of state-level rules and inconsistent federal enforcement is unsustainable, and that without a strong federal framework, the United States will continue to fall behind. Economist Michael Green sums it up. Digital assets can transform finance, but regulation is a challenge. The countries that get this right will lead the next economic era. Linda Zhang, a respected professor of financial regulation, adds, clear jurisdictional boundaries are needed for regulators. Without them, innovation will be stifled and consumers left unprotected. Meanwhile, innovation is not standing still. Ripple continues to push the boundaries of what blockchain technology can achieve. The company is now pioneering digital identity solutions, leveraging the security and transparency of blockchain to combat online fraud and identity theft. According to Ripple's research, these new systems could reduce fraud rates by as much as 40%, an impact that could save billions annually for banks, merchants, and consumers alike. This is not just theoretical. Pilot programs are already underway, and early results are promising. Institutional interest in digital asset custody is booming. Hedge funds, asset managers, and even insurance companies are exploring how to integrate digital assets into portfolios, seeking diversification and new sources of return. Ripple's infrastructure, trusted by major organizations, is well positioned to serve this growing need. And while some central banks remain cautious, others are moving aggressively to test stablecoins, digital currencies pegged to traditional money, using Ripple's technology to make cross-border payments faster, cheaper, and more reliable. Let's pause here and consider the broader context. The digital asset market is not a niche hobby. Globally, it now commands trillions of dollars in value, with daily trading volumes surpassing those of some traditional stock exchanges. Over 55 million Americans now own crypto assets, a figure greater than the populations of many countries. For these individuals, regulatory clarity is not an abstract concept. It means safer products, better consumer protection, and the confidence to participate in the economy of the future. So what happens next? What if Congress finally answers Brad Garlinghouse's call to action? Imagine lawmakers come together, setting aside partisan divides, to pass comprehensive legislation like the Genius Act or the Lummis-Gillibrand Responsible Financial Innovation Act. These bills would do more than just define which regulator oversees what. They would lay out clear, enforceable rules for everything from how digital assets are issued and traded, to how custodians safeguard your coins, to what disclosures are required for investors. The potential impact is enormous. For companies like Ripple, it means the freedom to innovate without fear of arbitrary enforcement actions. For institutional investors, it opens the door to new products. Think exchange-traded funds based on XRP or other digital assets, available to American savers and retirees. Already, financial analytics firms are tracking every XRP transaction, providing a level of transparency that was unthinkable just a decade ago. Ripple's partnerships with leading universities are growing as well, helping to train the next generation of blockchain engineers and legal experts right here in the United States. But the benefits go far beyond the boardroom. For ordinary Americans, clear rules could mean faster, cheaper payments, whether you're paying rent, sending money overseas, or shopping online. Digital identity solutions could make it much harder for criminals to steal your information, while giving you more control over how your data is used. If fraud rates drop by 40%, as some studies suggest, that's more money in your pocket and less wasted on costly recovery efforts. Access to global markets would also expand. Entrepreneurs could launch businesses with customers anywhere, confident that their payments would arrive instantly and securely. Developers could build new apps and services, knowing exactly what the legal boundaries are. Investors would have more choices and greater protections. And for the millions of unbanked or underbanked Americans, those who struggle with high fees and limited access to financial services, the promise of blockchain could finally become reality. However, the alternative scenario is far less rosy. If Congress fails to act, the regulatory fog will persist. Companies will continue to operate with one foot out the door, wary of investing in American jobs or infrastructure. Already, we have seen a steady migration of talent and capital to Europe, Asia, and Latin America, where crypto-friendly laws are attracting a new wave of startups and investment. In these regions, governments are not just tolerating innovation, they are actively encouraging it, racing to become the world's blockchain hubs. The consequences for the United States could be severe. Not only could the country lose its edge in technological innovation, but it could also cede critical market share to rivals. Imagine a world where the next big payment platform, the next digital dollar, or the next breakthrough in online security is built not in California or New York, but in Singapore, Berlin, or Sao Paulo. The United States would not just fall behind in technology. It would lose its voice in setting the standards and rules that govern the future of finance. A patchwork of state laws could create even more confusion. Businesses would face conflicting requirements, making compliance costly and complicated. Consumers might see a widening gap between the best services available elsewhere and the outdated options at home. As Ron Hammond, a prominent policy analyst, puts it, "The Genius Act is a step, but more action is needed. Without federal leadership, we risk fragmentation and stagnation." Let's not overlook the human dimension. For many Americans, crypto is not just about speculation. It is about economic empowerment. It's the immigrant sending remittances home without losing a week's wages to fees. It's the entrepreneur raising capital from a global pool of investors. It's the artist selling digital creations directly to fans, without middlemen taking a cut. These stories are playing out every day, quietly transforming lives and communities. What about the risks? Of course, there are legitimate concerns. Crypto markets can be volatile, and scams do exist. But comprehensive legislation can address these issues. Just as past reforms made traditional finance safer after periods of turmoil, strong rules around transparency, consumer protection, and market integrity can weed out bad actors while letting innovation flourish. The future is not set in stone. Several possible scenarios are on the table. In the most optimistic, Congress rises to the challenge, providing the clarity and stability that innovators crave. The United States reclaims its position as the global leader in digital assets, attracting talent, investment, and new businesses from around the world. The digital dollar becomes a model for other nations, and American consumers enjoy safer, faster, and more flexible financial tools. In a more pessimistic scenario, regulatory inertia persists. Innovation stalls, or worse, moves abroad. The United States becomes a follower rather than a leader, left to adopt standards set elsewhere. Market growth slows, and ordinary Americans miss out on the benefits of the next wave of financial technology. There is also a third possibility, a patchwork approach, where some states take the lead, creating mini-hubs of crypto activity, while others fall behind. Federal regulators continue to rely on enforcement actions instead of clear rules, leading to confusion and costly legal battles. In this world, progress is uneven, and the United States struggles to coordinate a national strategy. What is clear is that the decisions made in the next year or two will echo for decades. The digital asset revolution is not waiting for Washington. Every day, new innovations are being launched, new markets are opening, and the competition for leadership is intensifying. Sheila Warren captures the urgency. Regulatory clarity is essential for fostering innovation. For viewers, the message is simple but powerful. Pay attention. If you care about the future of money, technology, or even just your own financial freedom, now is the time to get involved. Learn about the issues, ask your representatives where they stand. Support organizations fighting for smart, balanced regulation. The rules being written today will shape the world you live in tomorrow. And do not be fooled. Ripple's ambitions extend far beyond payments. The company is quietly developing blockchain-based digital identity solutions that could redefine online security and privacy. Imagine a future where your digital identity is secure, portable, and completely under your control. No more endless passwords, no more data breaches. Just seamless, safe interactions across the digital world. If these solutions succeed, they could open